I think part of the difficulty is that big e-fulfillment centres and then the smaller parcel delivery, same-day delivery centres are viewed as non-standard logistics operations and buildings. And as a result, the traditional logistics market and investors in traditional logistics are pricing those buildings probably at a discount, or that's what it would seem. But I think that needs to be looked at in the context of the wider investment market, because you'll end up investing for, let's say, core logistics with an average weighted unexpired term of 4 to 5 years in most of the main portfolios, in reasonable markets, maybe a second generation building built in the mid-2000s. And then you're comparing that with brand new facilities that are predicated on an exponential growth of the underlying operators in a market that's totally undersupplied, with buildings that, yes, are at the large end or small end of the scale, but they're fulfilling a completely different operation, and they're going to be delivered on 10, 15, maybe 20-year leases. That risk profile, to my mind, is being priced completely incorrectly in the market at the moment, and I think there'll be people who start to change. Unfortunately, it's hard to prove because Goodman have been very successful at capturing lots of those kind of facilities and putting them into their funds. But I think there'll be a few to be traded and will come to the market, and there's a development pipeline being brought forward at the moment, which is going to show a shift in people's perceptions and how they're priced. And again, it's a dangerous parallel to draw, but if you look at the US, they're priced very differently in that market. And I'm going to just keep going and just put a couple of numbers before I stop. Just a couple of numbers on exactly what we mean by increased amount of capital into the market. Last year and the preceding year, about 8 to 8.5 billion euros of industrial and logistics transacted. This year at the halfway point, 7 billion euros has already traded in the market. That is a really material shift in volumes. That is happening in a different way as well. It's not all direct purchases and real estate. There have clearly been some big JVs, which Rob alluded to, and other people on the panel are involved in corporate situations at the moment as well. If you add all of that up, and I think your leading article on this month's publication was all about what those transactions are, without commenting on them specifically, that's 7 to 8 billion euros of capital structure changing in the market, in a market that normally trades at about 8 billion euros. And this time last year, we sat here and said we can see 19 billion euros of stock, and 2/3 of it's going to change. Well, 1/3 of it's happened so far, and that is going to change who you can buy from, how things are priced, and unless you're navigating that effectively and looking at those capital structures, just identifying buildings on the ground isn't enough at the moment in the sector.
Okay, yeah.
Just on that, I'd like to add that I think the biggest challenge for that money is going to be to find the product. What we have seen is that if you look at the past couple of years, there's been a real dichotomy between prime and secondary in the market, whereby the secondary market had almost dried up in terms of liquidity. And I think some of that capital will be forced to go back to the secondary market. So I'm expecting that there will be some more activity in that market again, which is ultimately a good thing for the sector as a whole. Likewise, I think people who have access to a development pipeline will obviously be in a favorable position. So from that point of view, I think it's going to be interesting. There's also going to be quite a difference between people who are there for the long-term investors and people who are perhaps more investing on an opportunistic basis with a shorter-term horizon, who can obviously take a different view on the market and therefore buy a different type of product.